Trader Merlin Show. It is your Thursday edition. Oh, tail, I gotta get dressed over here. Tail end of the week, and as expected, we had some disappointments today. At the end of yesterday's show, we were talking about how Apple and Amazon really had such a reliance on China that any sort of tariff disruption could have a big impact on them, and lo and behold, it did. Yeah, I did see that tweet also. That bar chart tweet was pretty funny. Says, thanks for nothing, Apple. Well, we kind of anticipated that this was going to be the thing. The question is, how far will we see it slide? What is the impact for tomorrow morning? So I put this picture up here, which I'm waiting for someone to give me grief that it's misleading and deceptive, because in all honesty, Apple's numbers were pretty darn good. But we'll talk about big tech earnings. We'll start things off with, what do I have there to start? I'll start with Amazon, I guess. We'll go to the Amazon chart here. Amazon reported earnings after hours, as you guys know. Unfortunately, I have not had time to read through everything like I want to. Just took the high-level numbers here. At a high level, I think they did pretty darn good. If you see here, we've had earnings per share of $1.59. Market was expecting $1.35, so maybe Jeff Bezos could launch some more people into space as a novelty mission. Their revenue was $155.7 billion versus $155.1 expectations. So, hey, you made $600 million more revenue than people thought you were going to make. I call that a big W. Now, if we look at the price chart of Amazon at present moment, it's interesting because today we were up 3.13% in the regular market hours. And of course, that was all happening because of the big gap up with Microsoft and Meta, which we can look at here as well. So it shot up here, you had the big gap up, and it, some intraday volatility, but not too much. And now in the after-hours session, it's given it all back. We're down 4.15% in the after-hours, $7.90 per share at 182.44. That's where we are right now. And that's this little slightly dashed blue line here. I know it might be hard for you to see, so I will throw on a line right now, which tells you where we are right now. There it is. I'm assuming that little dashed horizontal line is green, so there is where we are in the after-hours session. Now, those numbers look pretty good, right? When you look at the data that I posted, now, of course, there's a lot of other components to it. The big part was them signaling the uncertainty because of tariffs. And that was exactly the talk track at the end of the show yesterday was, look, they may beat earnings. I actually thought Amazon would do really well because of built-up demand, that people trying to rush in and buy before prices start to surge up. I was one of those. I bought a lot of stuff, not a lot, but I certainly bought things that I may not have needed right now. But I bought them because I thought that maybe 3-6 months down the road, they could be more expensive. So why not just get them if I'm going to buy them anyway? And there's probably a lot of people like me, which is why we saw some better than expected numbers. I mean, that was a pretty good earnings share beat. Guidance, though, not that great. Guidance, again, uncertainty is the big word up there. I didn't see the exact numbers per share that they were talking about, but both companies, Apple and Amazon, said exactly what we thought, which was, look, our coming quarters are going to be a bit weaker because of the tariff and uncertainty that it presents, which is no shocker. So let's look at the chart here of Amazon on a 5-minute basis. At least it's stabilized with that initial 5-minute candle there. Brutal. Pretty big slide. And it's up a little bit off of its lows. If you want to go to the dead low here from when it broke down, we were down 5.24% on Amazon, which, I'd rather there be more downside movement. I really wanted there to be a much bigger sell-off here, maybe falling all the way down to 160. Why not? Give me a big panic, blow-off bottom here where people just lose it, and then I can go and buy Amazon at lower levels. I know some of you own Amazon. Let's see. Big Eb says, I took puts on Apple and Amazon today. We'll see after the call start. No, yeah. Yeah, we'll see. So you bought directionally your long puts, and if you bought them today, before market closed, fine. Obviously, you're not going to buy them after market close. So I think you are right. The premium was probably massive. I would assume there's a huge premium that you had to pay to get those options. However, I just can't see things looking rosy for them going forward. And of course, the rift between maybe Amazon and President Trump right now. I heard someone, they were talking about posting on Amazon, potentially posting the price that the tariffs are costing these goods that have added to goods, which would be, I don't know if that'll happen, but that would be pretty interesting to see. Every time you bought something on Amazon, oh, here's how much the tariffs have been added to that, and it's increased over the past, 3 months or whatever. That would be crazy. At least as my Amazon long call profits are most likely going to be red tomorrow. Yeah. Well, I mean, at least you held long calls going into earnings. So, I mean, these are, you know me, my thoughts on options and earnings is really, really sketchy. For example, I have I have NVIDIA, but I'm not too worried about that. Never mind, I'm going off on tangents. All right, so that was your Amazon earnings. Again, there's a lot more detail to this in market segments, which were better or worse, but I have been just so slammed I had to have a chance to look at that during regular market hours. I'll get to look at that tonight and see exactly where the big weaknesses are. Next is the bigger one, the one I'm most concerned with, is Apple. So here's your Apple graphic I chose, and I said, I actually had another graphic which is a rotten Apple, but honestly, their numbers aren't rotten. I'm going to run through a whole bunch of stuff here. So earnings per share. They came out at $1.65 versus expectations of $1.63. So they didn't have blowout earnings, but they certainly beat earnings. Depending on which estimate you were looking at, some people thought of $1.61, some were thinking $1.63. They came out at $1.65. So they pretty much beat most analysts' expectations there. That's great. Their revenue was $95.4 billion. Expectations were $94.66. Also a nice beat there. iPhone revenue. This is an area that I thought I'd see slow down. $46.8 billion was their number they came out with. Expectations were $45.8 billion. All right, well, you beat by almost $1 billion there, or you did beat by $1 billion in revenue. That's great. Mac revenue, that also increased from $7.95 billion to $7.77. iPad revenue increased as well, $6.4 billion to $620. Their wearable home accessories, that shrunk. Right, so wearable home accessories, they had $7.52 billion. Expectations were $7.95. So there's your miss for Apple. Services revenue, $26.65 versus $26.7. So barely missed there. Gross margins still amazing for Apple at 47.1%. Based off these numbers, again, you would think that things are looking rosy for Apple and that their price chart would be screaming to the upside. Well, lo and behold, we go look at the old AAPL. Things were looking fine today. During the market, we had a decent, nice move intraday on it. But now we're sitting down near these lows. Honestly, it's not that bad. The sell-off we're down right now is 2.8%. It's still holding. Oh, you're still holding it, but it's still holding its level here. To me, not that bad of a play. Again, I do think that the conference call will give us more clarity as to where the strength and weaknesses are with Apple and with Amazon. And based off my gut feeling, I think there could be more downside movement here. Again, tomorrow morning will be the big opener. And of course, we have a tremendous amount of economic data coming out tomorrow morning, which I think we all should be relatively aware of. It's the big stuff. It's your unemployment claims, but we'll talk more about that as we progress here today. So off to a gloomy start for your Thursday session, but that was to be expected. Actually, a great start to your Thursday session. This will be a gloomy start to the Friday session. As you can see here, NASDAQ is already taking a little bit of a dive. It's forming a shooting star candle right now because those earnings have pulled it down in that new session. So there's your going into the close, and there's your NASDAQ 100 right now. So a bit down as we speak. We'll see how it all ends up at the end of the day. Now, tomorrow morning, I'll bring up the economic data that's going to happen tomorrow morning. You have quite a bit of data that could propel this market in either direction. So let's quickly jump from Apple and Amazon, which I think we all anticipated being a little bit of a downside move, to the economic data, because that's a much bigger driver, in my opinion, is what the big picture says. What's a shooting star formation, Tanya? Well, let's just, the audience knows. I know we've got a new participant here, so welcome to the show. Let draw one for you. A shooting star is simply a formation that shows up where price action displays a specific pattern. And you're like, okay, that says a lot. Here is what I'm going to draw out for you. So bear with me as I draw this on your screen. Typically, what you have with prices is things moving, trending in directions up or down. So here we have price moving up, right? So that's that little line representing price moving up. Then price may look like this. I'll paint this red, so bear with me as I do all this live on the show. And then I will add in a line, goes right here. Okay, let's go. There we go. Well, it's not exactly giving me a straight line, is it? Love when things don't give me a straight line. Give me a straight line. I want a straight line. Here we go. Okay. So what you're witnessing, what you're seeing here is what's called a shooting star. This is essentially showing you that at one point price was very bullish. This was a big red candle, or a big green candle. And now at the end of the time frame, let's say this is a daily candle, prices came all the way back down and closed near the bottom. So what this illustrates, to me anyway, is things were looking great. Price was trending strong to the upside. And then all of a sudden, out of nowhere, the sellers came back in and said, no, we've had enough, and they pushed down to the downside. And we ended near the low. That's what this red candle represents. It closed at the low for that range. Now what that tells me is momentum has now shifted. All before this was nice bullish upside movement. Things were looking great. And now all of a sudden prices are coming down and moving lower. So it doesn't mean that this is going to crash. It just means that there's been a change in sentiment. So I have a rule of thumb on how I trade this. My audience will be able to tell you. But I essentially will draw a line right across the bottom of that candle. And I'll say if it opens up above that candle and breaks below it, that's when you're shorting. You're looking to go short this market or whatever it is once it breaks down below that line. And that's essentially where we are right now. That would be a shooting star on one side, and then on the other side you have what's called a hammer formation. So let's draw both of those. And essentially I'm just going to copy and paste this stuff. All right. We're going to go copy. And a hammer formation is where price is going much lower, been trending down. And then you have, sorry, the lines are not quite right. And then you have a stall. Remember, at one point, this is a giant red candle here. And then all of a sudden it comes ripping back up. And ideally, in a perfect world, that candle would not be red. It would be green. So there's your shooting star and hammer. Shooting star is on the left-hand side. Hammer formation is on the right-hand side. And both of those are very good, in my opinion, high probability trend reversal patterns that I look for on a daily basis. So there you go. A hanging man. Oh, you want to, now you're throwing a little wrench in the works for me, bud. Let's draw a hanging man as well. Let's do a candlestick show today, shall we? Here is a hanging man. So let me, there is a hanging man formation, and I will take all of this off your screen. A hanging man just looks like this. There's your hanging man. Now, remember, according to Steve Nissen, a hanging man formation represents a bearish sign. It represents a reversal. I disagree, because remember, when you look at these price patterns, what happened? Well, at one point, this was a gigantic red candle. It looked like this at one point. Horrible. And then all of a sudden, the buyers came in, pushed it back up, and it closed near the high. And you had that buying pressure push up. To me, in my opinion, it's put a line across the top of this bad boy and wait for a breakout to the upside. But, you know, different strokes for different folks. I just see that candle by itself as a momentum piece that tells me the buyers came in and pushed things up near the end of whatever time frame that is. And therefore, in my opinion, this is a bullish pattern. Thanks, John. Gotta love PowerPoint. No problem, Tanya. And thanks for the question. Thank you for the question. Welcome to the show. Hit subscribe and like so we can get more of your questions answered. This is the first time that sellers even show up. It's the first time that shows. Well, in this picture, it's the first time that the seller's shown up aggressively. You could argue that every little dip, sellers simply outnumbered the buyers, right? That's really what these sell-offs represent. But the preponderance of buying pressure is to the upside here, where you're seeing, you know, higher highs, higher lows. That's the uptrend. And this may be a reversal. For me, if you had to weigh them, hanging man versus a shooting star, oh, without question, shooting star is what I'm looking for. Because that really signifies that it had a huge move up, a blow off top, if you will, something very bullish, and then just screamed back down, closed near the bottom. Now, most of my regulars know this, but when you look at price charts, I don't want you to just think, oh, well, it's currently trading at $26.50. I want you to think of it's a price war. It's a battle between buyers and sellers at all times. Every candle that you see is a miniature battle, a conflict between those who think it's going up and those who think it's going down. And out of that, we can start to gain a psychological perspective of what's going on with this security. Ultimately, when I look at a price chart, yeah, I know that this is the NASDAQ, or I know that this is Apple because it's got that ticker symbol on it. But in all honesty, who cares, right? You're simply looking for what this price chart is telling you. And right now, it's telling me that on Apple, things are very optimistic. You can see the big rally up off these lows, that it's like been overdone. But it's also coming into a series of lower highs. So right now with Apple, you're kind of at that point of, I wouldn't want to be a buyer right now of Apple. Oliver says, doom and gloom Merlin loves his shooting stars. Hey, to be fair, I actually prefer a hammer formation. I believe a hammer formation is actually better because markets are built to go up, right? Markets are built to go up over time. Therefore, if I can buy something off an emotional change like a hammer, that's even better. The reason that I do like shorting so much, Oliver, and you know the answer to this one, is because most people don't short. Most people don't know how to short. And that just blows my mind. I think most people believe that you just have to buy and hold over time. It's, again, like buying a car that has no reverse. Like, how are you going to parallel park? You got to be able to short these markets. And while I do have generally a bearish bias because I think things are overdone and chaotic and uncertain, right now I'm making money on long trades, right? I'm making money with the market moving up. So I'm long MicroStrategy. I'm actually long SMCI, which that one hurt yesterday. And I am technically not holding NVIDIA, but I'm making a long play. I sold puts on NVIDIA at 104. So, I'm betting the market's going to continue to keep on moving up. So even though you call me this doom and gloom, I'm still looking for the upside potential here. And when things reverse, then I'll be going outright shorting or buying directional puts or even selling calls. Do you care about shooting stars on lower time frames? Great question. I think that there's a certain power to time. And to the point that, was it Margaret made in there earlier about the shooting star on the weekly gold? That has a tremendous amount of power. Because remember, it's now, is a battle that went for 5 minutes really important, or is a battle that went for a week really important, right? There's a lot more emotion in a weekly candle. So it's a great point there, Margaret. If you look at gold futures and go onto the weekly time frame, right? Look at this last week's candle. Not only did we get a shooting star with this really long topping tail and a red body that closed near the bottom. Doesn't have to close at the dead low, right? But it just near the bottom. Not only did we get that, but if you go back to when this candle formed, right? This is last week this happened, and we talked about this on Friday's show. That's what the picture looked like. And the rules I just drew out on your screen were exactly that. I went to the low of that candle for last week, which is 3,270, and today we broke down, not today, but on the weekly candle, we have now broken below it. Now, Bob Dunn will tell you that you need a close below it, so jumping on short now of gold would be rather aggressive. But absolutely, I think there is much more power to the bigger picture, the bigger time frames. Am I looking for a hammer formation on a 1 minute time frame? Me personally, no. I'll be honest, I don't even look at 1 minute charts anymore. And remember, I used to be one of the most active traders you'd ever meet. 1 minute was my bread and butter time frame, and I realized, well, I didn't realize it. My mentor told me to stop looking at 1 minute charts. He said, step back, look at fives. You're going to drive yourself crazy on every little move that happens. It's just, that's like trying to serve every ripple in the ocean. It's not going to happen. You need to wait for the bigger waves. There's more movement on a big wave. And quite often, surfers will go out to the ocean here and just look, and if there's no huge waves, they're not getting in. Why waste their time? Same thing for me with a 1 minute time frame. My trading got much more consistent. I got stopped out a lot less when I went to bigger time frames. So there you go. Great point. Big Eb says contrarian. I generally do find myself as being contrarian. I do. Whether that's a fault or a strength, I don't know, but I will admit I do find myself being more contrarian. However, Big Eb, as you guys have seen, yes, I'm contrarian, but I'm very quick to go, hey, I'm wrong. No problem. I'm wrong. Move on. Let's jump on that trade as it stands. So, Joe says, for me, it's all about the premium and volatility. Certainly, that's a big factor in it. If you're an options buyer or seller, then volatility is massive and critically important. As far as anticipating where things may go over the next day, week, month, I think you got to look at candles, right? Because if I'm going to be buying puts, buying directional puts, then I better have a good feeling that these markets are going to go lower. For example, if you look at this gold chart, buying directionally long gold puts probably would have been okay as we broke that 3270. Why? Because of that candlestick formation. And what that probably is going to lead us down somewhere into, my guess would be somewhere around 3,050. So you got 220 points on the gold futures contract. That's plenty, right? Plenty of big move there. So yeah, I think the candlestick formations and chart patterns help me look at when things might be turning, the psychology of it, and then plan a trade around that. But, to each their own. Everyone can do things slightly differently. Let's see. What else do you have here? Bull and bear moves are a must to see and understand, but they both behave differently. Yeah, typically down moves are faster, more dramatic. What do they say? Going long is taking the stairs up, and shorting is taking the elevator down. Right? It just goes typically much faster, but not always. Right? Not always. Today it moved below the low of the shooting star. Yes, so today was the day. I didn't look at that, but we can just bring up the daily here and check that bad boy out. Boom. So today, there's your break. And notice, last part of the tail end of last week, we kind of bounced. We stuck there. That's what gave us the shooting star near the bottom. And then you look at where we opened up. We didn't break it on Monday, Tuesday, Wednesday. Today's your trigger. There's your short. Now, to be fair, when I looked at this on the daily time frame, my eyes instantly go over to this sideways consolidation that it had between the prices of this. To me is your demand zone on it, and we're literally at the bottom end of it. So even though it broke that, I need to know where it's most likely going to stop. And in all honesty, if it doesn't stop now, right, that low point of this yellow box is 32.08, and the low price of gold today was 32.09. So we were 1 penny off that dead low. Now the question is, what happens here? Does this hold? If it breaks, then I think you're coming all the way back down to these lows that go back to April 8th. All right, and that's 3,000. So right now, that break would have pulled in, if you're trading, maybe to that low, maybe 60, 70 points. But it's the lower one here that's the real big opportunity, and that's going to be like 200 points. So there you go. Let's see, what was it? The end of day ES. Yeah, you had a pretty big, and I think that the reason we saw that today in the S&P was Apple's earnings, just the expectation, and maybe things were leaked out. And it's not just Apple; it's also Amazon. But those two companies have just such weight, such power. I think people were kind of freaking out and trying to price that in here, as you can see there. There's your last 15. Bam! Right, even on SPY. Bam! No, pretty sharp move going right into the close there. So, all right. So hopefully that answered your questions on the shooting star formation. Let me real quickly run into some of this economic data because I think that this is important. And Michael, I actually copied down your question from yesterday. So let me get to the Pfizer here in just a second. You're thinking way too much on fundamentals. Fundamentals are manipulated and may not be worth much. So let's talk about economic data here real quick, and then we'll dive into that. Again, remember Cody yesterday was talking about how, the economic data is not that relevant. You really shouldn't pay attention to it. It's just price. I disagree. I think you find that happy medium of joining fundamentals for the bigger picture, right? And then you're trading that smaller picture. That's how I view it, right? If other shows will have different perspectives of it. But what does the data look like today? It was not good. So if you look at, let me refresh this. If you look at the unemployment claims, they were expecting unemployment claims to go from 223,000 up to 224. We came at 241. So unemployment claims starting to creep up, and that's a decent jump up past expectations. That's your first piece that came out 1 hour before the market opened. Then we had manufacturing numbers. The final manufacturing PMI data showed a decline. We're still above 50, which is good, but it's right at it. 50.2, we were supposed to be 50.5. So that is slowly starting to get weaker and weaker on a manufacturing front. But the big number happened during market hours, 30 minutes in. That's the ISM manufacturing PMI. And I'll bring up a chart for that. We were at 49. They thought it was going to be 48. We came out at 48.7. Remember, we need to be positive here. You need to be above 50. 50 represents the cutoff line of optimism. So going all the way back into November of 2022, we've only been above 50 on April of 2024, February, and March of this year. Other than that, it's been a year and a half of, actually 1 year, 2 years, two and a half years of negative numbers for this ISM manufacturing PMI. Now, maybe the Trump policies will have an impact in 6 months to a year. I think it'll probably be longer than that if we do continue with these tariffs and force manufacturing back to the U.S. But this is really not great for the U.S. economy to have just this prolonged decline in manufacturing PMI data. More bad stuff. Prices. Okay, this isn't too bad. People thought that manufacturing prices were going to soar and really spike to the upside. The previous number was 69 point. Previous number was 60. Let me look at the previous one. This is updated. Previous number was 69.4, and now we've jumped a little bit to 69.8, which actually is not that bad. Now remember, you talk about inflation. We looked at yesterday's core PCE price index. Inflation was under control, right? 0. Well, then why are manufacturing prices rising? If manufacturing prices are rising, that's a sign that there's inflation. So someone's lying. There's some bad data out there somewhere. And then we could look over here from that bad economic data and take a peek at the unemployment claims. I already covered the unemployment claims, so my bad. I'm out of order. You're out of order, Rothfeld. Those unemployment claims are the ones that are going to set the stage for tomorrow's activity. Again, here's your unemployment claims. That was a pretty big jump. You can see that spike there, but it's not out of the ordinary, right? You see them spike every now and again. That's okay. What you'd like to see is next week when we get our unemployment claims, that number comes back down and it's in the 220, maybe 225 range, somewhere in there. 241, definitely higher. Now tomorrow, we have big pieces of data. Tomorrow we have obviously the unemployment claims, and I'll look at that here in just a second as we wrap up, because that's going to be pretty important. The unemployment claims themselves, not that big a deal, but the unemployment rate is the big deal that the Fed is looking at. So that is the big stuff for the day. From a trade perspective, like I said this morning, I've just been teaching every day for 3 hours. Tomorrow I'm doing it again, so I'm going to be busy teaching, not active, which is fine. I have a bunch of positions open, and we'll see if how those trades expire tomorrow. I'll certainly give you the update. Big Eb's probably kicking himself for getting out of his MicroStrategy. Sorry, Big Eb, I had to poke fun at you for that one. It's just like, I think you even said it yesterday. You said, great, I got out of my MicroStrategy. It's probably going to surge tomorrow. Oh boy, did it. Let's take a peek at MicroStrategy. It was a pretty good day. Oh wow, it came back down quite a bit. At one point today, MicroStrategy hit a high price of $403. Love that one. Nice move there, but you talk about a great looking trend, but MicroStrategy's really been doing very, very well. Now, I'm probably going to have my shares taken away from me. I'm probably not going to roll it, right? I have a 377.50. Exactly, Big Eb, 100%. I agree with that. So I have, as you guys know, I've had multiple points where I've purchased this. So let me just show you. So there's one purchase price was at 352. That was my early entry. And then as it fell, I picked up a bunch at 320. So I've been long. I'm still long just 600 shares. So there we go. So a bulk of mine is purchased down here at 320. And I've been selling covered calls against it, collecting premium for weeks and weeks and weeks. I rolled it last week. I was underwater on Friday when we closed. So I rolled it and got out of closed my covered calls at 352.50. And then I sold the 377.50s. And as of right now, tomorrow, my 600 shares of MicroStrategy might disappear. I am totally okay with that because, again, a bulk of it was bought at 320. I'd be selling out at 377, which is $57 per share profit. It's going to be on 500 shares. So that's great. And then I've also been collecting premium. So this should turn out to be a pretty good trade if it gets taken away tomorrow. If it doesn't, I do have a MicroStrategy spreadsheet. It's downstairs. If I close this one out, Margaret, I will bring that one up and share that one with you guys. This has been one of the longer trades I've been in with covered calls. I would say it's got to be going on 3 months of just selling covered calls against this position and turning out, as of right now, love it. Great. They don't always work out like this, right? There's some that you just got to bite the bullet, jump ship and get out. But this one has been doing pretty good. So I was funny because I was debating today, do I roll it with the expectations that we're going to keep on going? As I mentioned yesterday, I think that the month of May is the month where we get Bitcoin back to all-time highs. All-time highs. John says, every time I try covered calls, I get washed. Yeah, I know. It's unfortunate, but it's it always seems to happen that way. You're like, I don't want to get rid of it, but I'll sell covered calls just to create more income stream and lower my cost basis. And then like that's the 1 week it just goes gangbusters and takes you out. It's like, go, why? I know. That's the way it is. And as Lisa says, MicroStrategy profit potential is addicting. 100%. It is absolute addiction there. Well, Rob says, same, I suck at covered calls. I guess maybe you're selling covered calls too close. You know, when you sell a so let's say you're doing covered calls for a week. I bought Microsoft, and let's pick something that's not that volatile. Let's say I picked, I don't know, let's go U.S. Steel. All right, so let's say, for example, you bought U.S. Steel, and you're looking at it and going, oh, you know what, I'll be okay if selling this if it gets above this previous high that we saw back on April 9th. So you look out here and you say, okay, it's currently trading at $43.46. This is in the regular market hours. And see you, Thomasina. Have a great day. And then you got to look at it and say, what kind of premium am I going to get if I sell it at $46.50? If that's even a strike, depending on what it is. It probably is, but maybe it's 46 or 47. Well, if I do it at 46, I'm increasing my chance of being filled. And if I do it at 47, I'm decreasing that chance. If you really don't want to get out of your position, then just set it at a much higher price. Yes, you're going to get less rate of return, but that's okay. Selling covered calls, in my opinion, is not about getting rich. Selling covered calls is like picking up a couple nickels and dimes or maybe quarters that are on the ground, part of a bigger trade, right? So I didn't buy MicroStrategy so that I could sell covered calls against it right away and that be it. No, I bought MicroStrategy because I thought it was going to go up, and I've been selling covered calls at prices that are higher than where I thought I would be executed. I don't want to have my shares of MicroStrategy taken away. That's kind of the perspective I have on it. So if you're selling covered calls at the money, yeah, you're probably going to have your shares taken away from you. It's just the way it works, unless you feel like prices are going to be going down. So I generally sell them at a much higher price. Covered calls, sell 20 deltas after a big move up. If you're going off the Greeks, yeah, I just go off of location. The Greeks, I don't know. I know I'll get feedback for this one, negative, but I don't really follow the Greeks. I go off of supply and demand. I go off of price charts. So that's really it. And then typically, if I'm doing something like I was with MicroStrategy, I'll be looking for rates of return. So if I went out here and I go to that X chart, you go X, check out that chain. And the number we talked about on X was 46 or 47. Right now we're at 43, 46. I'll go out here, look at that option chain, and say, all right, I want to add some rate of return to my trade. Let's go to next Friday. So I'm doing a week out, right? Going out 1 week. And if I look at the $46 calls, I hate this one. It doesn't give me enough expirations, and I don't use this platform at all. There we go. Let's go to the 47s. So 46, if I sold the $46 calls, it's a huge spread. I'll split the difference here, but maybe I can pull in 60 cents, which would be a 1.5% rate of return for 7 days, 8 days now. Do I think I'm gonna get that taken away? Okay, maybe I'll go higher up and go to the 47s and I'll make 1% rate of return. So that's the logic that I have. I try to keep it very simple and not overcomplicated. So if I didn't want these shares taken away from me on this U.S. Steel, I'd probably go for the 47s. Because if it made another $3.50 by next Friday, I'm pretty happy with that. And then I'll also make an extra 1%. Fine, I'll just sell puts again and do rinse, wash, and repeat. Do it all over again. Maybe that's my issue. I'm trying to get big enough amounts, usually like 2 weeks out. Well, the more that you're trying to make on the call, the closer you are to current price, right? And that's the risk. Typically with puts, when I'm selling puts, I go by supply and demand zone. So if I find it coming into a demand zone, like I did with the NVIDIA trade, I was loving the 100. The 100 was awesome. So I just kept selling puts at 100, and I sold a bunch of them. Those expired worthless. Bummer. I would like to have owned NVIDIA at 100. As it bounced, I went by the rate of return that I wanted, so I ended up getting a 1.5% rate of return for the week for the 104s. That's what I sold last Friday, and all things being equal, I should end up not owning NVIDIA this Friday. You can see there's the 104 strike. that we came right down to yesterday. I was almost going to sell some more, but I've just been too busy with this class and teaching, so I decided not to mess. I've already got a pretty substantial position, at least for my accounts. You sell calls at supply zones and puts at demand. No, I don't generally sell calls. If anything, I'm going to be selling puts at demand zone, and then if I get executed, I'll be looking to sell covered calls above the supply zone. That's the simplest way to do it. E. So what I'm learning is actually earning reports only affect some companies. Others are based on speculation. That keeps a good mix up for the retailers. Just another way they... Well, look, like yesterday when you had, or today, when the markets opened, we had the impacts of Microsoft and we had the impacts of Meta, right? And notice what happened there. Big jump up, and that was all priced in pre-market. So if you're trading pre-market, great, you had opportunity. If you're a normal retail trader, you would not have gotten any of this action. You'd actually be losing today, even though it was up 4.32%. And if you look at Microsoft, that also was the big piece here. And remember, this is one of the heaviest weightings in the NASDAQ and S&P and Dow. I mean, these are big components here that, of course, impact all the markets. Now, because Microsoft and Meta reported so good, you're like, oh, well, that should have an impact on things like Amazon. Yeah, it gapped up too, even though this really was not reflective of Amazon's earnings or Apple's. Apple certainly looked a lot worse than the other ones, but generally, an earnings announcement in a specific sector will have an impact on all those companies. So as you mentioned, retailers, if you look at something like Abercrombie and Fitch, let's say Abercrombie and Fitch has absolute blowout earnings, then, maybe Gap is going to have a jump up as well because it's a sympathy play, but it doesn't necessarily mean that those numbers are going to be good for its peers. Yesterday's discussion was talking about, Microsoft and Meta being a little more immune to the Chinese issues and tariffs, whereas Amazon and Apple direct hit. Let's see, what else have I got? All the way, you could have gotten Nvidia under $100 if you had the call during the DeepSeek debacle. I could have. I'm not too worried about it. I would have liked to have owned Nvidia at that price. I actually did own some back here, and I sold calls. I think actually it may have been, I don't remember exactly when it was, but I had some Nvidia that I was executed on. I sold covered calls and got taken away, and it may have been on this big spike here. The ultimate goal, specifically in this account that I'm sharing with you, the account that I share on this program is really, I'm trying to get 1% per week. That's the baseline goal that I have for that account, is getting 1% per week. In doing that, I'm taking more risk than I did last year. Last year, I was shooting for 1% per month. In that account, I achieved that, and I'm just being more aggressive this year, and that's why I'm sharing those trades with you to give you some insight as to what I'm doing. I don't particularly care whether I own it or not. The goal really is I need to make 1% per week. That's the benchmark that I have for myself. So if I can pull that off, I don't care whether I own it or not. Certainly it's nice to say I own Nvidia, but the reality is if I can put 1% in my pocket per week just selling puts against it and never actually owning it, it's all the same to me. All the same to me. No, 1% per week. It was 1% per month was the ideal, but 1% per month being conservative, and now I'm being much more aggressive. So 1% per month is, per week's very good. I mean, look, if you got 52 weeks a year, you're going to bring in 52%. I wouldn't say that is a monumental, astronomical rate of return, but doing it in such a consistent manner that I've been doing it, I'm happy with it. Yep, absolutely compound, VB. You betcha. What percentage of the portfolio do I allocate per trade? I don't put anything into one position. If that's the ask, I won't put it all in one position. So I'll put as much as 50% of the account in one position, but I'm not going to put it all in one. And if I do that, I have to make sure I'm going into a peer group that's not the same. So for example, if I go half that account in, let's say, MicroStrategy, I'm not going to open another IBIT position because that's still tied to Bitcoin. I'll go into something else. In the 1% per month, the approach was sticking with, and for the newbies out there, the 1% month approach was using these ETFs like, XLB, going with diversified ETFs. Unfortunately, the premium is just not there to do 1% per week. it's way too risky to do these on a per weekly basis, in my opinion, right? If you are looking at something consistent, then yeah, the 1% strategy I talked about, using ETFs, whether it's SPY or QQQ, or even getting specific like energy and retailers or financials, stick with an ETF so you don't get caught off guard with a massive gap down like I did with SMCI yesterday. However, you're probably going to have to take too big of chances to get 1% per week here. I've been trading much more volatile stuff, and granted, that's been working for now. We'll see. Who knows what the future holds? At the end of the year, we'll do a summary of it as well, and I'll break down the different accounts so you can see, how they perform. But so far, this one's doing pretty darn good. I've been finding myself going down to a 1 minute time frame. I've been getting my butt kicked every day. New rule put in my book. Thank you. Yeah, man. You know what? I would never have thought that. So I would never have thought that a 1 minute chart was my undoing as a day trader. When I started to become more of a swing trader, it was like, look at the 5 minute. And my mentor said that. He said, you're going to get stopped out way too much on a 1 minute time frame. It's frustrating. You become self-defeating. You're like, I'm a loser. I get stopped out all the time. Stop looking at a 1 minute chart. I'm like, okay, fine. And so I went to a 5 minute, and things get a little bit slower. You're not reacting to every little tick on that chart. It's just more calming. And maybe you go to a 15 minute time frame. I like the 5 minute as my lowest time frame. I've mentioned how I have my screen setups here. I have typically 8 charts at a time. Well, 10. 2, 4, 6, 8, and then 10. So I have a 5 and a 15, 5 of the market and a 5 of the specific security. So market's all on the top row, and then the specific securities on the bottom. So if I'm looking at, let's say, Microsoft would be on the bottom, and QQQ would be on the top, or the NASDAQ 100 futures. So I go 5 minutes, 15, hourly, 4 hour, and then daily. And the daily is my biggest time frame piece. I generally start there and see what the bigger picture trend is, and then I can work my way backwards. But sometimes by looking at so many different perspectives, you can get a better feel for what price may do. Again, I don't know which way it's going to go, and quite often I'm wrong on my forecasts, and that's okay. I'll get stopped out with a little bit. But the more time frames you look at, I think the better feeling you get about where the demand zones are, where the areas of problem might be going forward, and that just puts probability in your favor. So good. Glad that helped out, Glenn. Let me know how it goes. A 5 minute chart should help you out quite a bit. All right, let's go into this top 5, and then let me do Michael's question since he's been patient. I hope you're still here, Michael. And I wrote it over here. Michael sent in a couple questions. Let me read it. I copied and put in a Word document. He says, Pfizer sold off because of tariffs to report a profit of 92 cents was a 26-cent beat that the CEO raised outlook again like last with new drugs getting approved. So let's go first off and go over here and look at PFE. Okay, so there's your Pfizer chart. The only positive thing I can say for Pfizer right now, sorry, Michael, is that it's had a great run for the past 2 weeks, right? You're up 16.85%. And this is great, but I know you didn't buy it on April 9th. I know you did not buy this a couple weeks ago. You bought it somewhere back here in this avalanche of negativity and downward price movement that's been going on in Pfizer since late 2021, right? We peaked out here on December 20th of 2021 at a high price of roughly $61.70, and here we are at $23. And that's after a 16% rally. So this is a garbage chart. It's trash. You're catching a falling knife. Now, the second part, he says, Pfizer announced the 43-cent dividend last week and sold shares in a drug company in the UK to raise $3.24 billion more cash. Since tariff is not hurting earnings, that fell from $28. That with strong earnings report should climb back up to 28 since people need these medications every day. Okay, so I mentioned this before, Michael, and I'm trying to be like the brotherly love kind of thing here, tough love, if you will. In my opinion, there's 2 camps. You can either put yourself in that fundamental camp where you're just literally diving in and analyzing as deep as you can the financials and the fundamentals. I don't think that you're that guy. You're reading what the media is putting out there. Okay, here's the earnings call. The owner is buying more shares. They're going to issue a bigger dividend. They're going to do a buyback. That is the public facing, let's feed the people what they want to hear so they buy our shares. Remember, the reason you pay a dividend is if there is no big growth opportunities for your company. If Pfizer was really in the mood to make a new product and bring out some new drug, right? I don't know, I'll be optimistic and say that Pfizer creates a drug that cures cancer. Okay, we all understand that Pfizer has never created a drug ever that cures something, that makes the problem go away. Pfizer creates drugs that you take to make yourself feel better, make the pain go away, make you less schizophrenic, whatever. It does not heal anything. I had to get that out there. That just bugs me. Would I back the truck up? if they had a drug that cured cancer, they would never cure anything. Anyway, if they had that drug that made cancer better, what would happen is Pfizer wouldn't pay a dividend. They would cancel their dividend, and they would put all their money into R&D to build a better drug, a better pipeline, a better system, better delivery, whatever, but they don't see the opportunity. That's why they pay a dividend. A company that's growing and expanding doesn't pay a dividend. They put money into R&D and growth, into new products, into new facilities, into hiring. When things get slow, they have a choice. They can take that earnings and they can invest it in the company, which makes shareholders richer. Instead, what they do is they pay a dividend, and they do that to entice consumers to buy their shares. Buy our share and you'll get a, whatever you said, 48-cent dividend. Oh, great, great, great. And this bugs me because let's go and see what the actual dividend is, percentage-wise. I think I can do this in TradingView, but I will do it. I'll do it in Yahoo Finance because I've always used Yahoo Finance. Makes it easy. Let's go PFE and see what percent dividend they pay. Okay. So Pfizer, oh, it doesn't give me the yield right here. Isn't that nice? We don't get the dividend yield. But let's just say Pfizer pays a 5% dividend. All right? I'm making this up. I don't know the dividend yield for Pfizer. Let's say they pay a 5% dividend. If they pay a 5% dividend and the stock drops 10%, did you make money? No. They actually pay a 7% dividend, 7.05% dividend. So let's say they pay a 7.5% dividend and the stock drops 20%. People hold on to dividends like, oh, yay, I got paid. I get these quarterly dividends. I'm making money. Yeah, but you're down 20%. So you can gloat about dividends all you want. If the stock is going down, what's the point? For me personally, and again, it's my show. This is my perspective. This is not everyone's perspective. Others would disagree. And hey, you know what? I'd like to have a debate with somebody about this at some point in time. I would rather have a company that invested in the share price, which gives the price more movement and volatility. So I can, whether I'm selling options or buying directionally, I get bigger trend moves. That's where I trade. That's how I trade. Again, if you're a dividend person and you want those income streams, fine. But look at what Pfizer has done, and you can pick any time frame. So they pay 7% per year, right? 7% per year. Right now, Pfizer for the year is down 10%. And that's after a huge rally. So even though you got your dividend, you're still down. Oh, but wait, let's look at last year. Let's do another one. And I'm not trying to pick on Pfizer. I see this happen quite often with dividend-paying companies. So let's go to last year. And let's go make sure I get the exact. So there's your January to the end of the year. The share price of Pfizer was down 10%, but you made 7% dividend, which means you lost 3%. Overall, even though you collected money, you lost 3% on this in a year when the equity markets were up 25%. So these are bad investments. I'm sorry. This is bad investment. So I don't really care personally what Pfizer is saying, what their dividend is, what their product pipeline is. I'm looking at the price chart. And the price chart tells you everything that is known or knowable with a company. And right now, what it's telling me is the people that know don't like Pfizer. Now, to be fair, Pfizer's not going to go away. Way too big. It's got too many drug products. At some point, Michael, you'll be able to look at me and go, well, you're right. You're right. or you'll say I was right. Because at some point this is going to have a big bounce. At some point it's going to have a big move to the upside. It'll be worth the assets of the company, the facilities and the patents and the drugs. It'll get down to a base price, a book value, right? And if it does, then maybe I'll be a buyer. But I don't like buying things in the hope that they come back. I like buying things that are trending and look strong and have big prospects. So there you go. And you mentioned up there at the top, you said Pfizer made a profit of 92 cents, was a 26-cent beat, which is on new drug approved. Obviously, you look here, do people care? Did people care? So yeah, they beat earnings here, and they beat earnings by 38%. That's a huge jump. So you can say they beat earnings, but look at their revenue. They missed revenue by $204 million. So yeah, you can gloat about a new drug, you can gloat about your earnings, but revenue declined, and they're actually losing money. Not losing money, sorry. They're making money, but they've dropped 1.47% on revenue. That was their miss, $204 million. Ouch. So remember, numbers are the devil's work, man. They can manipulate those numbers all they want, and they keep you believing by showing you the good numbers and keeping the bad numbers out of your sight. Look at the chart. The chart tells me it's bad. Okay? What else do I have here? So here says, Merlin, what do you think about UNH? Ooh, UNH. We talked about this when the CEO was assassinated, and I believe that was back here in December of last year. And I thought, man, this thing's just too big. It's going to have a big bounce, and it did. I'm not a healthcare fan. I realize healthcare is for everybody. You got to have it, but I just don't like healthcare. I think that it's just this necessary evil that keeps people sick and makes themselves money, as opposed to healing. So I have a rule for myself, which is I can't trade drugs and I can't trade biotech or pharmaceuticals. So for me, I would look at this, I almost lump this into drugs. It's a healthcare, I know. If you look at this chart, it's an absolute free fall right now. Something is devastatingly wrong with this. It's down 30% in just the past 3 weeks. This is bad. Their earnings were bad. I actually thought about selling puts on it, trying to catch this falling knife. I'm just not comfortable with it. For me personally, it's just too risky. So let's go out and look at a weekly and see, are there any areas on this that might be appealing? We're actually coming into one. And if you look here, I'll move this red line down. Right around 380, we had a double bounce. And after that, I think you're looking at a much lower level, probably closer to 328. So I still think it's got some downside movement to it. But yeah, the premium's great. I'm sure the volatility's off the charts. It's just not for me. It's not an area. It's not an industry I'm interested in. Like, I'm interested in NVIDIA. I'm interested in MicroStrategy and what they do. I'm interested in SMCI. I'm more of a tech guy. But healthcare, way too volatile. Nuts for me. Let's see. Last one, CVS. All right. So CVS, if we looked at it back here, I would say garbage. This is a weekly time frame, Robert. So this is a weekly time frame. It bottomed out really in January of this year. And still looks ugly, And right there, literally as of, what day is that? In early March, it came back up to a pivot, to a swing high. I would need it to break that. That would tell me that at least there's some confidence coming back into it. And lo and behold, we are now right there. So I'm starting to feel a little bit more optimistic about CVS. I think there's a ton of competition for CVS. With Amazon Drugs and other companies doing online sales and stuff, that certainly puts a lot of pressure on CVS. But I'm a fan of them as a store. I use them all the time. Whenever I have a cold, easy to run and grab whatever I need, and just like it's almost like a 7-Eleven with a drugstore in it, right? It wouldn't personally be buying this one, but I do feel more optimistic about the price chart of CVS at this moment in time. Okay, I gotta go. Let me real quickly. My phone is blowing up here. What's going on? Who's looking for me? All right. Let me run through our top 8 here, and then I'll wrap it up and go into our Friday review or Friday overview. For today, obviously the big news was the broad market indexes, but they were not the worst one. The worst one out there was gold, and this is your weekly time frame of gold. I'll switch it to a daily here so we can see that one. Gold sold off right into that demand zone that we talked about earlier today. So I personally would anticipate there being a little bit of a bounce in gold. If it gets down below the low end of that, which is 3,208 on GC futures, I think you got a much bigger down move play here. Dollar index was up 0.55% today. This one's very interesting because it's been on an aggressive downtrend, but it's also starting to stabilize. You know, we talked about it bouncing back and forth between these two yellow boxes I have on the screen. Well, now we pierced it to the upside today. Didn't close above it, but if we get a close above that high price, which is about 100.27, I think you'll see this dollar start to traverse back to the upside. It's just kind of about due for a little bit of a reprieve here. It's been on a real ugly sell-off for a couple months now. The Russell, 0.62%. I'm not that impressed with the chart, even though it's been trending up. It's just been kind of chopping sideways, but slowly going up, so that's fine. Same thing here with the S&P. The bigger picture with the S&P is you've got a shooting star today. You got that, shooting star formation on this daily on the S&P. That leads me to believe we might see a bearish Friday, which is fine. Get my MicroStrategy below 377.50, and I'll just roll and sell some more covered calls at 390 or 400. NASDAQ, same picture. Shooting star. I know I've got all kinds of drawings on here. Let's get rid of some of this stuff. I'm going to keep my little ascending triangle here, a cup and handle that we've had drawn out, because what that tells us is if we do break to the upside on this pattern, we should, let's see, click there and click there. We should see a move to the upside that brings the NASDAQ 100 up to 22,284. That'd be a 15% move on this breakout. We'll see. I don't think we'll get there, but that's what the measuring object is telling us, and that would bring us right back up to those all-time highs, which, as I remember from yesterday, some of you were talking about Bob's done attitude that big crashes happen from all-time highs. That would bring us right back to the all-time high. And let's go to the 10-year bond. Lots of chop, bottomed out today with that long topping tail. I don't see much technically here. Let me get rid of these old lines. They don't matter anymore in my opinion. I'll just get rid of, I'm going to delete all the drawings. All right, so we'll leave this one. I don't see anything really technically here on the 10-year that's going to cause me to, be optimistic or pessimistic. Crude oil, down below that yellow box, which I still have not updated my numbers here. I want to go and see what other analysts and people say about the extraction cost of gold in the U.S. John Rowland said between 60 and 65, which is why I have that box there. That tells me that currently it's 59.24. Each barrel of oil that gets pulled out of the ground, producers lose 75 cents based off of John's numbers, right? We will see. I don't know. Looks fairly negative right there. At some point, they'll stop extracting, and that should drive prices back up. And we'll see if drill baby drill happens. I really don't know what happens with crude oil. My expectations for the year were we're going to see it go down significantly, and we are. But what point does it stall out? And your big victor for today, which is a very nice price pattern, by the way, Bitcoin. It feels like today was a little bit of a breakout of this last 5 days of kind of sideways choppy with no real direction. You had higher volume today. There's a lot of optimism about Bitcoin. There was a rumor going around that the government's going to sell their gold and buy Bitcoin. I don't think that's going to happen. I think that would be absolutely crazy. Anyway, can we congratulate Trump about lower crude oil? Sure. I mean, he'll take credit for it. I don't know if I would congratulate him, but certainly the actions of our government and the politics may have had a hand in this one. So, yeah, sure, why not? Oil, yet to buy heating oil is still high, $2.60. Heating oil, what's that? Who uses heating oil, Lisa? You East Coasters in your frigid winters. All right, I got to wrap up here. I've got another thing I got to do at 3 o'clock, and I'm already behind. So let me just throw this out there for what's happening tomorrow. I mentioned tomorrow, from an economic perspective, is a big day. I will go to the calendar, and it's probably one of the more important ones for the week. When we scroll down here and look at the Friday calendar, notice a lot of red stuff here. The reds imply very important, and that really is around average hourly earnings, non-farm employment change, and unemployment rate for the U.S. Right now, expectations are 4.2%. We have seen some of the jobs data this week come out a little bit more negative, so it would not surprise me to see this jump to 4.3%. But at this point, I think they want to keep employment numbers as low as possible, so they'll cook the books and keep it at 4.2. But I think we'll be at 4.3 tomorrow. That's that. And then on the earnings front, good news. All the big heavy hitters are out of the way, but we do have 91 companies reporting earnings tomorrow. On the big side of things, you've got Berkshire Hathaway, ExxonMobil, Chevron, Shell, Eaton, Cigna, Apollo Group, and that's pretty much it for tomorrow. So that said, don't go there. I hate having oil. Natural gas is preferred. Yes, natural gas is the way to go. That's going to do it for me, everybody. If you have comments, questions, feedback, things you'd like to know, you can email me at tradermerlin@gmail.com. For those of you who are new, since I see we have some new people here, you can hit that subscribe button, hit the little bell. It'll notify you when I go live with the show, which is trying to be on time at 2 o'clock every day. Seems like I've been 2:01 every day. I'll try to fix that one. But that said, everybody, hope you have a fantastic remainder of your day, and it's going to be a wild, exciting Friday. Hope you make some money, and I'll talk to you tomorrow.